Welcome to the Apartify podcast, the show where we teach you how to use other people's money to finance your multifamily deals. I'm your host, Roderick Jones, and I am excited that you're joining me here on another episode. On today's episode, we're talking about the complete multifamily financing guide from A to Z. Let's get into it. So when we say large multifamily properties, what exactly am I talking about? So here at Apartify, we finance large multifamily properties. And my definition of large multifamily properties is anything with 100 units and above. So when we say multifamily in this whole entire podcast, or when you hear me talk about multifamily, I'm talking about financing large multifamily deals with 100 units and up. Anything that's less than 100 units, maybe 80, maybe 70, we can still finance. But for the most part, I'm talking about 100 units and up. I'm not talking about duplexes. I'm not talking about triplexes. And I'm not talking about quads. We're talking about large multifamily properties, 100 units and up. So when we talk about multifamily properties, why do people invest in multifamily properties? Why is this even a attractive asset class? Why is this sector, bringing investors to it? Why is it attracting investors? It's from mom and pop investors all the way to institutional investors. What is it about multifamily that makes investors want to invest? Well, I'll tell you. Multifamily investors want to invest in multifamily for two main reasons. One, either cash flow. No, I would say three, not even two. I would go with three main reasons. One, they're either investing for cash flow. Two, they're investing for appreciation. Or three, they're investing for portfolio diversification. So let's get into the cash flow. So when we say cash flow, this means that investors are putting money into a property so that way it can pay them money back. Meaning that it wants them investors are investing to a deal because they want this deal to pay them month in and month out. They want to put $100 in and get $8 back. They want to put $100 in and get $10 back every single month. So they're investing so that way they can get cash flow, because cash flow is what creates passive income, and passive income is what allows you to become financially free. So a lot of investors invest for passive income. So a lot of investors invest for cash flow, which is also known as passive income. Let's go over to number two. So number two, investors invest for appreciation. And appreciation is you buy a property at a certain amount. Let's say you buy a property for $100 today. Appreciation is how much you'll be able to sell the property for in the future. So if you buy this property for $100 and you're buying for appreciation, this means that you're looking to sell the property for $150 in the future or $200 in the future. Now, this can be higher or lower, but just for the simplicity of this example, you buy it for $100, you expect to sell it for $200. That is buying for appreciation, meaning that you're buying it low and you want to sell it at a higher price, and you're not really focused on the cash flow in the middle. And then lastly, portfolio diversification. So investors invest for portfolio diversification. What exactly is that? That means they're heavily relied on paper assets such as the stocks and bonds, or traditional assets such as stocks and bonds. They're heavily relying on traditional assets such as stocks and bonds, and they want to diversify their portfolio, meaning they want some of it to be in traditional assets and some of it to be in hard assets, meaning things like real estate and alternatives such as private equity and things like that. But for this video, we're talking about multifamily. So they're in paper assets and they want to diversify into hard assets and buy a physical property that allows them to generate cash flow and allows them to, when the stock market is down, they could potentially be up on their real estate. And when their real estate is down, they could potentially be up on their stocks. So portfolio diversification. That is the third reason investors invest. So let's head over to market analysis. So when people are looking for deals to buy, when investors are looking at deals and saying, okay, I know that I want to buy large multifamily properties. I know I want to buy for cash flow appreciation or portfolio diversification. Now, when I'm looking at these deals or when I'm looking to buy, what type of properties am I looking at? What am I looking for? What should I be considering when picking a market? Those are all great questions. And here's what you should be considering and looking for. So there are two main drivers that really drive a good market. The first thing is job growth. And the second thing is population growth. So the first two factors that you're looking at when considering a multifamily market is job growth and population growth. Why are those important? One, because if people have jobs, they can afford to pay the rent that you're looking for your building. And then two, if a market has job growth, that means they're bringing people there. And job growth causes population growth. And when people move to an area and the population is growing, what does that create? A demand for housing. And so that's where you come into play as the multifamily owner. You know that people are moving here because they're getting jobs and the population is increasing. Being that the population is increasing, these people need somewhere to stay. And if they need somewhere to stay, how about you buy the building and rent some spaces for them to stay in? So you get what I'm going. Top two metrics, job growth, population growth. You follow those trends, you will always hit a red hot market and you'll be okay. You don't follow those trends and you're at your own mercy. But don't say I didn't tell you so. So we got that out of the way. Let's head over to part two. So part two is funding the deal. So this is the whole premise of this entire video. How do you finance a multifamily deal? Not just any multifamily deal. How do you finance a large multifamily deal? That is what we're talking about. So when financing a multifamily deal, you need to understand the options that you have available. You have plenty of options available. You have bridge loans, you have bank loans, you have agency loans, you have CMBS loans, you have life insurance company loans, you even have private loans. All of those are available to you when financing a multifamily property. But the question becomes, with all of these loans, how do I know which one is the best one for me? And how do I apply for these loans? Are you looking at my credit? Are you looking at my net worth? Are you looking at, my track record? What exactly are you looking at to help me qualify for financing this multifamily property? So let's get into it. So when financing a multifamily property, these are the exact steps that you're going to go through from a lender and from an investor's perspective. So you find a deal. Once you find a deal, you are in the process of, is this a good deal or is this a bad deal? That's when you're underwriting the deal. So when you're underwriting a deal, this is when you go ahead and figure out, what are your investors' returns, what type of metrics you're trying to hit. All of those go into effect when looking at a deal and evaluating a deal and understanding whether it's a good deal or a bad deal. And you'll hear me say the term underwriting throughout this presentation or throughout this video. And underwriting is just basically analyzing. So every time you hear me say you're going to underwrite a deal, just replace underwriting with analyzing, meaning that you're going to analyze a deal. So underwriting equals analyzing. So when you're underwriting a deal, making sure that it's a good deal and making sure it's a fit for your investors, let's say you actually come across a deal that works and you're like, hey, this deal works. I want to move forward with this. The next step that you should do is send it to your lender. So if you're working with one lender, that's great. If you're working with a capital advisor, that's great. If you're working with a commercial mortgage broker, that's great. Here at Apartify, we are capital advisors. We are commercial mortgage brokers. So we go out into the market and we find you the best financing possible for your multifamily deals. So when you have a deal that you are looking at, it's best to get your lender's eyes on it immediately. So send it to your lender, send it to your commercial mortgage broker and say, hey, we want to write this deal. We want to buy this deal, go ahead and underwrite it. Give us a soft quote. Let us know what we should expect from rates. And so this is a good thing. Don't feel like you're being a pest or you're being a lot when asking for soft terms or seeing if they can, size up the deal for you, because it's not. That's what your lender, that's what your commercial mortgage broker is there for. They're here to size up deals for you and let you know where rates shake out, so that way you can underwrite the deal to the best of your ability. So you send this out to your mortgage broker and you let them know, hey, size this up for me. Let us know what we're expecting. So soon as you figure out this is a good deal and you want to pursue it and you're going to submit LOIs, all that, send it out. Let them know, hey, we found it. We think we found a decent deal. We're going to pursue it. We're going to submit LOIs. We're in the very early stages. Can you give us some loan sizing on this deal? So you go out, you do that, you send it to them. Then once you do that, the next step is they're going to give you some loan sizing. They're going to give you some soft quotes. Once you have those soft quotes, you plug it into your underwriting model. And then from there, you go and submit your LOI. Once the deal is under LOI, this is where everything starts to flow. So once the deal is under LOI, this is where you're going to start getting term sheets. You're going to start shopping the deal. So your mortgage broker is going to go out to the marketplace and they're going to get you the best rates. Now, when the mortgage broker starts the process, here's the first thing they're going to request. First thing that you're going to have to do is sign an engagement letter. Now, what is an engagement letter? An engagement letter is basically a letter up front that lays out the terms for this engagement, meaning that your mortgage broker is going to work for you for a certain fee. And that fee is anywhere from 1 to 5%. If you're getting charged 5%, it's probably because you have a smaller deal, or it's probably because that deal has a lot of hair on it, meaning that it's a very complicated deal. And then if you're getting charged 1%, that means you have a standard deal and it's nothing special. It's just run of the mill kind of deal, and rates really fluctuate around 1%. And then if you're over $100 million, rates go down to about half a basis. First thing you're going to do is sign an engagement letter. This says that your mortgage broker is going out to work for you for 1% fee, and these are the lenders he's going to talk to. And basically, it lays out everything that he's supposed to do in this agreement. Once we have the engagement letter out of the way, next thing you want to do is fill out a 1003, which is a standard commercial real estate loan application. The reason this is important, and the reason your lender is going to make you do it, or your mortgage broker is going to make you do it, is because this is a document that most all lenders are going to ask for when financing a multifamily deal. And if you don't have a 1003, if you don't have a version of the 1003, go to apartify.co/1003 and we'll get you a copy of it. You can download a copy of the 1003 and just fill it out, so that way you have it ready and you can send it out on every single deal. And basically on that 1003, it is basically going through who are you, what are you doing, what is the deal, all of that. So if you fill in the top half and the bottom half of it, meaning who you are and your entity, and then the bottom half of it, meaning your personal financial statement, the middle portion you can change for every single deal. So every single deal will be different in the middle, and you can keep the same 1003 and you can just go in there and change, update the middle for deal by deal basis. So I always recommend having your 1003 ready to go and just having it ready to send out for when your commercial mortgage broker requests it, because it's going to be requested for every single deal. You might as well fill it out, have it ready to go and ready to send. So if you need a copy of the 1003, go to apartify.co/1003 and we'll get you one. So next, they're going to request that 1003. After your 1003 is requested, then they can go out and start shopping the market, shopping the rates. This is very important. So that 1003 is what every lender is going to look for. So when your commercial mortgage broker is sending out your package, they're sending that 1003 because the lender is going to ask for more information. And it's important that they have all the information they need on this particular deal, so that way they can get you the best rates. Once they go out there and they start shopping the deal, they're going to come back with something called a term sheet. And basically, a term sheet is the sheet that lists out all the terms from the bank, that the bank is offering. So your term sheet will have, what is your loan amount? What is your LTV going to be? What is your interest rate? It'll have your loan term. It'll have how your interest rate is calculated, and it'll have your earnest money deposit. All of that will be on the term sheet. And so they're going to go out and get you 3 to 4 different term sheets and say, here's the term sheet from each different lender. We have this option, this option, this option. And then they're going to help you pick out the best loan for this particular situation. Once you have a term sheet, Once you have a term sheet, the next step from a term sheet is to sign the term sheet and then send in the good faith deposit. That is standard across every multifamily deal. You're going to have a good faith deposit. That good faith deposit is going to range anywhere from, I would say, 5,000 to 20,000. This good faith deposit is what the lender uses to go out and order your appraisals, go out and order your third party reports, go out and pull your background check. All of that good faith deposit, all of that is including your good faith deposit. And this is what they use to go out and get all those third party reports for this particular deal. So you need to be ready to pay anywhere from 5,000 to 20,000 for a good faith deposit for your multi-family loan. That is going to be standard. So make sure you have 15, make sure you have 5 to 20,000 for your good faith deposit. So after you fill out this good faith, after you sign the engagement letter, you send in your good faith deposit. Now this is where underwriting starts. The lender is going to underwrite you and the lender is going to underwrite the deal. So when they're underwriting you, they're going to want to make sure that you have these three things. One, they're going to make sure you have the net worth to do the deal that's equal to or greater than the loan amount. They're going to make sure you have the liquidity for between 5 to 9 months. And I want to make sure that you have the track record of doing deals of this similar size. And if you have all three, then this works. If you don't have all three, then this is where you have to recruit a team that has everything you need. So if you have the track record and you have the liquidity, but you don't have the net worth, this is where you go and partner up with somebody else who has the net worth. And you say, hey, let me use your balance sheet so that way I can do this deal. And once I get this deal done, I'll give you a fee for it, blah, blah, blah. So whatever you work out as far as your team is concerned, that's what you work out. But you need to have a net worth equal to or greater than the loan amount. You need to have a track record of doing deals of similar size. And then you need to have liquidity between 5 to 9 months in reserves. So that's what you need. So they're underwriting you on that, and then they're underwriting the deal. Make sure that it hits the debt service coverage ratio that they're looking for, which in most cases, if it's a stabilized deal, they're looking for 1.25 or they're looking for 1.15 if you're looking at a Class A property. But for most properties, if you hit that 1.25 DCR, you'll be good. They're making sure that you have the LTV requirement, meaning that your LTV is not higher than the amount of debt service you can service. So if you, let's say they initially quoted you 75% LTV, but in order for you to hit the 1.25 DCR, your LTV needs to be around 65%. Then when you sign your final loan documents, your LTV is going to be 60% and your DSCR is going to be 1.25. That's where, most multifamily investors kind of get on the rocks and they don't understand. You quoted me 75%, but now you're telling me it's 65%. What happened? What happened is the deal doesn't make enough cash. And being that the deal doesn't make enough cash, the lender can only give you a certain amount of proceeds. But if the deal made more than enough cash and it still could hit the 75% LTV and it can hit the 1.25 DCR, then everybody's happy. But it's when that DCR doesn't quite make sense, that's when the loan proceeds start needing to come down. So that's that. Underwriting a deal, make sure it hits all the covenants that it needs to hit. 1.25 DCR, making sure that the LTV is not higher than what they can lend out, and making sure that the deal cash flow and it can pay for itself. The number one thing that the lender is looking for first is the deal. They're looking at the deal to make sure that the deal is good. After they look at the deal, then they're looking at you to make sure that you are good. And if you are not good, then they're looking at the team to make sure the team is good. I'll always say, even if you are good, make sure that you have a team so that way it looks a lot more better it looks way better on paper, and you can go in and sell the deal a lot more. You can go in and sell the deal and get financed quicker, knowing that this is going to be, knowing that you look very good on paper and the lender is going to be comfortable lending you out millions of dollars to go and purchase these large multifamily deals. Now, we're in due diligence. So we're in the middle of due diligence. This is where the lender is underwriting you and doing all that. During this due diligence time frame, after they're underwriting you, they're also getting the third-party reports. They're getting the environmental reports. They're getting the phase 3 reports. They're getting all of these reports, the appraisal, all of this to make sure that the deal is a sound deal, make sure it's up to code, make sure that, their money is protected as well as your money. So they're getting all these reports, and this entire process should take anywhere from 30 to 45 days. Now, if you're using a bridge lender, some bridge lenders can say we can get it done in 7, but standard process in commercial real estate when dealing with large multifamily properties is about 30 to 45 days. This is how long this due diligence / underwriting period takes. After all of these come back, then you get the green light for closing. Green light for closing meaning that you checked out, you gave the lender all documents that they needed for underwriting, and the deal looks like it's a good deal. Now, we do have a list of all the documents that the lender will need to underwrite a deal. If you need a copy of that list, make sure you go to apartify.co/list. And this will give you all of documents. This will give you all of the documents that the lender will look for when underwriting your multifamily deal. Once again, that's apartify.co/list. This is basically a due diligence checklist of all the documents that will be required from the lender for your multifamily deal. So after you come out of due diligence and after you come out of underwriting, you get the green light to close. After you get the green light to close, you have about 45 days from then, 30 to 45 days from then until you actually close. So this is where the lender is, getting all the capital getting everything that you need as far as capital pooled, as far as setting up all the things that the lender needs to set up behind the scenes to get your loan ready to close. All of that goes into play. So you have the green light to close, and then from the green light to close, you have about 30 to 45 days. During this time period, this is where everything is being finalized. All the formal agreements are being signed. Everything is really coming to a close. So that way on closing day, you can just sign and walk away. After that, you close the deal and then you move on to the next deal and you repeat that process over and over and over again. So let's summarize this whole video. When we're talking about large multifamily properties, we're talking about 100 units or more on this channel. Next, when people invest in multifamily properties for 1 to 3 reasons. 1, they invest for cash flow. 2, they invest for appreciation. Or 3, they invest for portfolio diversification. In order to determine if a market is a good market or a bad market, make sure you look at the top 2 metrics make sure you look for these top 2 metrics, job growth and population growth. If jobs are moving there, 9 times out of 10, the population is growing. And if the population is growing, 9 times out of 10, people need a place to stay. So look for job growth and population growth to determine your market. Top 3 things that a lender looks for when financing before they finance your deal is top 4 things that a lender is looking for before they finance your multifamily deal is number 1, they're looking at the deal. Does it hit the DSCR? Is the LTV where it's supposed to be? And is it a good deal overall? Is it in a good market? Is it in a good market? Is it in a good market? Is it A class? Is it C class? Is it B class? All of that is what the lender is looking for. Number 1, they're looking for, is it a good deal? Number 2, they're looking at you as the borrower. As the borrower, you need to have 3 things in order to qualify for a multifamily loan. 1, you need to have a track record of doing deals of a similar size. Either you or your team needs to have that track record. So if you have if you're looking at a 100 unit deal, you need to have a track record of doing 100 unit deals. Number 2, you need to have net worth and liquidity equal to or greater than the loan amount. So number 1, your net worth needs to be, if you're looking at a $1 million deal, your net worth needs to be $1 million or more, or your team's net worth needs to be $1 million or more. And then lastly, you need to have liquidity, meaning that you need to have 5 to 9 months of liquidity in the bank ready to go. So you need to have net worth, track record, and liquidity to qualify for a multifamily deal. You or your team. And then lastly, the whole process from start to finish to financing a multifamily deal takes 60 to 90 days. You have 30 days in due diligence where they do underwriting and looking at you as where the lender will do underwriting, meaning they'll look at you as the borrower and they'll underwrite the deal and do all the third-party due diligence checklist that they need to do. And then you have 30 days after you get the green light to close. Or you have 45 days where they do all that and then 45 days to close. That's the reason why we say the process will take anywhere from 60 to 90 days. So that is it for today's episode. If You need a copy of the 1003. Make sure you go to partyfi.co/1003. Or if you need the due diligence checklist for all the documents you'll need to finance a multifamily deal, you can go to apartyfi.co/list. That is it for today's episode. Make sure you leave a like, make sure you review, and make sure you subscribe to the show. And if this show made you think, if it taught you anything new, make sure you share with other people. Let them know you listen to the Party Fi podcast. With that being said, I'll see you on the next episode.